什么？
Why? Just why? 3 days of losses, and today is the worst yet. Wasn't this supposed to be a bull market? Where did the bull market go?
不是，
At least I'm not the only one losing money.
牛市去哪儿了？
It's terrifying. Today, there's absolutely no hope. I have nothing left to say. I didn't sell everything today. I don't know if that was the right or wrong choice, but if things stay like this tomorrow, I'll have no choice but to cut my losses and run. 6 consecutive days of losses. I have no idea where I stand among other investors. Average? Below average? Dead last? I heard this was supposed to be a bull market. How could I lose for 6 days straight? Honestly, this feels worse than during a bear market. At least during a bear market, I knew to invest less. But this time, I thought it was a bull market, so I went all in. Between November 14th and November 18th, China's 3 major stock indices saw 3 consecutive days of losses. Net capital outflows from the markets surpassed 105.9 billion yuan. On November 14th, A-shares experienced a broad sell-off. The indices opened lower and continued to slide, with a sharp plunge in the afternoon. The Chinext index fell by 3.4%, and the Shanghai Composite Index dropped below 3,400 points. As A-shares fell, Hong Kong stocks also took a hit, with both the Hang Seng Index and the Hang Seng Tech Index opening significantly lower. Reports suggested that the market decline was partially driven by a rise in the US dollar index, which on November 14th reached its highest point in 2 years, surpassing 106.6. Following this, the Chinese stock market saw significant downturns. On November 15th, the downtrend continued, with another sell-off across the 3 major indices. The Star 50 index dropped by 3.94%. According to reports, by the close of the trading day on the 15th, over 1,700 stocks had fallen back to their September levels, with their closing prices lower than those on September 30th. These accounted for nearly 32% of all A-shares. Of these, nearly 390 stocks saw significant losses during the month, with prices dropping over 20%. By November 18th, the broad sell-off persisted, and the indices experienced their 3rd consecutive day of losses. The Shanghai Composite barely held above 3,300 points. Over 200 stocks fell more than 9%, while more than 1,000 dropped by over 5%. Trading volumes had also shrunk for 4 consecutive days. This relentless downtrend has become an almost daily occurrence in China's stock market. It's not that I'm avoiding making videos. This market is just so discouraging. It feels like I'm back in the same situation as August. Over the past few trading days, none of my stocks have seen a single day of gains. This afternoon, I found myself wondering, am I reducing debt or just begging for mercy? At this rate, all my money will be gone. Last Thursday, I suggested increasing tech stock positions. Today, I saw them plummet, and I wanted to buy more, but I didn't have any funds left. The stock market is such a bizarre place. When you're feeling confident, a big drop always follows, and when you're broke, good stocks are everywhere. When the market closed today, I checked my losses and couldn't believe how bad it was. I looked again, trying to see how many stocks were up versus down, and I noticed that the market's rating was listed as fair. Fair? Based on what? After a drop like this, how is that fair? I'm furious. Another investor who used a loan to trade stocks is now at the brink of despair. I want to warn everyone, only trade stocks with spare money. Never use money meant for business or take out loans. I used my working capital to trade. I opened a store this month, and between renovation, inventory, and deposits, it totaled several 100,000 yuan. I thought I could make a quick profit to cover renovation costs by investing in stocks. But as soon as I bought in, the market started falling. It's been devastating. This morning, I had no choice but to sell. Last night, everyone around me knew I was borrowing money from one person after another. I was like a madwoman, awake all night trying to figure out what to do. In the end, I had to sell everything. I've learned my lesson. I'll never use loans to trade stocks again. Chinese economist Yu Fenghui, author of Financial Technology, analyzed the situation. He wrote, "Recently, A-shares have been hit by a cold wind, with all 3 major indices sliding together. The Chinext and Beijing 50 indices have seen especially painful losses. Even the Shanghai Composite, which has been relatively stable, is now teetering close to the 3,300 point mark." market sentiment has cooled significantly, as seen in the shrinking trade volumes over the past 4 days. Investors have become more cautious. With over 1,000 stocks dropping more than 5%, it's clear that panic is setting in. This may be due to external uncertainties or disappointing domestic economic data. In such conditions, investors often adopt conservative strategies, holding back and waiting for clearer signals. On November 10th, as the Chinese stock market plummeted, several related hashtags trended on Weibo. These include, "Is the A-share bull market over?" and 3 consecutive days of losses for the 3 major indices. Popular finance blogger Qin Chuan Fanhua commented, "Is the A-share bull market still there? Of course not. If it were, most people would be making money. Funds wouldn't be fleeing in panic. The truth is, 2024 never had a bull market. Those shouting about a major bull run are now drowning in losses and gritting their teeth in frustration. The stock market remains the same old trap, where financial consumers never seem to learn their lesson, endlessly struggling to recover their losses." While some investors are still chasing dreams of overnight riches, China's stock market saw a record $16.9 billion in foreign outflows in just 1 month, the largest in history. Despite a series of stimulus measures introduced by Chinese authorities in late September, the market failed to meet expectations. From November 7th to the 13th, $7.4 billion flowed out of emerging market equity funds, marking the highest level since August 2015. Bond investment funds also saw 4 consecutive weeks of outflows. Funds leaving China's stock market have been particularly striking. After an initial surge following September's stimulus measures, disappointment set in, leading to 5 straight weeks of capital outflows, totaling $16.9 billion over the past month. Naoki Tsukioka, chief economist at Japan's Mizuho Research and Technologies, commented that the Chinese Communist Party's Congress, which concluded on November 8th, failed to introduce additional fiscal stimulus measures. This has fueled growing sentiment that China's stock market is underperforming. Those hoping to make quick profits are now jokingly referred to as debt transformers. Instead of gaining, they've had their funds swept away by the stock market, turning them into tools for reducing government and state-owned enterprise debt, a source of ridicule online.
You used to call me a stock investor, then a retail trader, and finally chives, ripe for the cutting. Earlier this year, I was labeled a financial consumer. Now, I'm called the most beautiful debt transformer. I'm just a stockholder, a laughing stock.
The term debt transformer refers to entities such as governments, financial institutions, companies, or individuals who assist in reducing or eliminating debt. Recently, the term has gained traction due to the Chinese central government's new measures aimed at relieving local governments' debt burdens. On November 8th, Chinese Finance Minister Lan Fuan announced during a press conference that starting in 2024, China will allocate 800 billion yuan annually over 5 years to address hidden debts. The funds will come from new special-purpose local government funds, amounting to a total of 4 trillion yuan. Combined with the National People's Congress approval of a 6 trillion yuan increase in debt limits, this adds another 10 trillion yuan in resources for reducing local debt. Lan explained that by 2028, the total hidden debt of local governments would decrease from 14.3 trillion yuan to 2.3 trillion yuan, significantly alleviating debt pressures. The government hopes this policy will ease repayment burdens for local governments, whose revenues from land sales have plummeted in recent years, falling short of covering debt repayments since last year. On the surface, these measures seem to support the economy and benefit the stock market. However, some view them as political maneuvers by the CCP. Political commentator Zhai Shanyin remarked, "Given the current economic decline and rising social unrest, a government skilled in politics but poor in economics cannot possibly reduce local debt by increasing its own. Strengthening local governments could pose a threat to the weakening central government. These so-called debt relief measures are just a way to consolidate central control under the guise of economic and social stability." Every decision by the CCP is politically motivated, whether public or private. This is no different from the former Soviet Union. The idea that these measures are for the benefit of local governments or the people is laughable, let alone helping people make money. Patrick Pan, A stock strategist at Daiwa Securities said no industry has notably benefited from recent stimulus policies. He expects short-term corrections in both mainland China and Hong Kong markets. Ho-Min Lee of Lombard Odier Wealth Management added that while Chinese stocks might help diversify exposure, relying on them as a primary driver of returns is unrealistic. This recent stock market rally has done little to boost the economy. So why has the CCP introduced these debt relief measures and stock market incentives? Many argue it's for political purposes. Some believe that these are merely performative policies that cannot truly resolve local government debt. Much of the debt is hidden and unofficial, making its full extent unclear. Critics argue that the CCP is leveraging the stock market, using a slow bull market to gradually extract the remaining savings of ordinary citizens.
Debt relief is something you must understand. Otherwise, you won't know how your money disappears. Take the US, for example. Their debt relief strategies include wars, like the Russia-Ukraine conflict, which profits the arms industry and allows the dollar to seize Ukraine's state assets. Another method is printing money, making global dollar holders foot the bill. China's main debt relief tools are real estate and the stock market, two vast reservoirs. Real estate was built up through massive borrowing, creating 450 trillion yuan in property assets. But who paid for it? Homebuyers, draining the savings of multiple generations. Now the real estate bubble is too big and dangerous to sustain. What's next? The stock market. The government introduces incentives to draw people in, only to turn the market green and siphon off funds. This so-called bull market is designed to eliminate a portion of people's savings, forcing money saved in banks into financial consumption. The recent stock market crash is essentially pushing ordinary people to spend by depleting their A-share investments.
Tsai Shanying further commented, I believe this stock market scam targets mainly China's middle and lower classes. Wealthy Chinese have many ways to grow their fortunes and rarely rely on the risky and time-consuming stock market. Those who fall for the CCP's lies and pour their savings into the market are naive. The global consensus is that China's stock market is a scam, yet so many citizens still invest. It's undeniable that China is a nation of scammers and the scammed. If people woke up to reality, society wouldn't keep repeating these mistakes. This latest A-share debacle has created yet another giant pit, leaving countless investors on the brink of financial ruin. Some Chinese netizens have raised doubts about the claim that the stock market is a scam. They argue that if it were, the market should have collapsed entirely. So why is it still holding steady at 3,300 points instead of falling back to 2,600? Official data from China's central bank for 2023 shows that Chinese residents had a total savings balance of 137 trillion yuan. Consumer loans stood at 58 trillion yuan, and personal housing loans totaled 38 trillion yuan. Subtracting these loans from total savings, the net available funds for Chinese residents at the end of 2023 amounted to 41 trillion yuan. This year, household savings have continued to grow, with an increase of 12 trillion yuan in the first 9 months, an average of 1.3 trillion yuan per month. However, in October, savings didn't grow as expected. Instead, they decreased by 570 billion yuan, adding the typical monthly increase of 1.3 trillion to the 570 billion decrease. Nearly 2 trillion yuan disappeared in October. Where did this money go? Almost all of it flowed into the stock market. That's why, even though the market is crashing, it's still holding at 3,300 points. This level is largely sustained by new investors who refuse to sell at a loss. Tsai Shanying commented, many Chinese investors are in denial. They don't believe they've been trapped. This 2 trillion yuan of new funds came solely from retail investors. There's no other source of new money in that market. Some still fantasize that the government will step in and bail them out. But how can a government that relies on local governments borrowing money to survive possibly rescue anyone? They're constantly thinking of ways to drain your funds. Prices for water, electricity, and gas are skyrocketing. Even if the government wanted to help you recover, where would they get the money? They're leveraging investors' reluctance to sell at a loss. By using small amounts of their own funds to manipulate the market, they encourage rotation between sectors, a tactic called sectoral rotation. If you have any sense, you'll stay out of the Chinese stock market. As for the future of China's stock market, both domestic and international analysts remain pessimistic. The Wall Street Journal noted that even if the Chinese government announces major stimulus measures, it would only provide short-term relief. With China facing significant internal and external challenges, such measures would likely come too late. The report also highlighted potential policy shifts in the United States. With Republican control of the presidency and Congress, President-elect Donald Trump's promises, such as raising tariffs and deporting illegal immigrants, are increasingly likely to become reality. This creates additional pressure for China. Morgan Stanley economists predict that before 2025, China has limited room to introduce substantial fiscal stimulus to boost consumption in the housing market. Meanwhile, the U.S. could expand its trade restrictions, further impacting Chinese companies' profits and market value. If the Chinese government fails to seize this window of opportunity and stabilize the economy, it may face its darkest hour yet under mounting U.S. economic sanctions.